You've probably noticed something strange. People are holding more cash than they have in years. Savings accounts are fuller, money market funds are bigger than ever, and yet financial stress keeps rising. At first, that doesn't make sense. More money should mean less pressure, but that isn't what's happening. If you're doing everything you were told to do and still feel behind, this is likely part of the reason. Here's what the data shows. By the end of 2024, households were holding about $18 trillion in cash. That's nearly 50% more than before the pandemic. Money market funds doubled in size over the same period. They now hold more than $6 trillion. By any historical measure, that's a lot of liquidity. At the same time, credit card delinquencies are rising. Personal savings rates have fallen below 5%, and household reports more financial stress than they did just 5 years ago. More cash, more stress. That isn't a contradiction. It's a signal. The issue isn't how much liquidity exists. It's who controls it. When you put money in a bank, you're told you have liquidity. You can move it, you can withdraw it. But what you actually have is access under certain conditions. Your deposit becomes a liability on the bank's balance sheet. They lend against it, they earn the difference. You might earn 0.5%. They lend it at 7, 10, sometimes 12. That structure works as long as not everyone asks for access at the same time. In March 2023, Silicon Valley Bank collapsed in under 48 hours. Depositors had liquidity on paper. In reality, $42 billion tried to leave in a single day. Access returned only after policy stepped in. So liquidity isn't just about money, it's about permission. And permission depends on confidence. Confidence depends on policy. That's not a flaw, it's how the system is built. There's another layer most people never see. Financial institutions don't earn much money when money sits still. They earn money when it moves. Banks earn when deposits stay in place and loans stay outstanding. Brokerages earn when capital rotates. Fintech platforms earn when you move money between features and accounts. Idle money doesn't generate much revenue, so the system quietly nudges you toward motion, rebalancing, sweeping, optimizing. In this environment, liquidity means you can move money, but only inside approved rails, on approved timelines, until control appears. What you can't do easily is step out quietly. The system is built for velocity, not for control. Most people are taught to think of whole life insurance as something that pays out when you die. That's not the part that matters here. When it's structured correctly, it builds cash value you can access. You can borrow against it when you need liquidity. There is no application, no explanation required, no schedule telling you when you have to pay it back. You're not draining the account. You're borrowing against it while it continues to grow in the background. The real distinction isn't the interest rate. It's that access is under your control. Whole life isn't meant to beat markets. It's meant to give you private liquidity when timing matters. Silver solves a different kind of problem. It's physical. You can hold it. You can divide it. And no institution sits in the middle. Bank accounts depend on banks. Funds depend on custodians. Brokerages depend on clearing systems. Silver doesn't depend on any of that. It doesn't pay you to hold it. It doesn't compound over time, and the price moves around. But access doesn't disappear when the system tightens. That's why it works as a reserve, not as an investment. Retail finance is built for scale, simplicity, and movement. Whole life moves capital outside managed portfolios. Silver moves deposits outside the banking system. Education tends to follow incentives, so liquidity gets taught as access through institutions, not control held by individuals. That works when conditions are stable. When they aren't, people find out they had access but no leverage. If you're holding extra cash, it's probably sitting in places built to keep money moving, not to give you much flexibility. That doesn't mean those structures are wrong. It means they don't cover everything. Quiet liquidity asks for more upfront. It behaves differently over time, and it forces you to think a bit longer term. If you're curious, start small. Get clear on what you actually need access for. Bills that can't wait, real emergencies, moments where opportunity shows up. Then look at your options through one question. How much control do I have when I need it? Over the long run, that structure matters more than the rate. That sense that something isn't adding up is usually the first clue. Not that you did something wrong, but that the system is built to serve a different goal. The exits aren't hidden. They've been here the whole time. Most people just haven't been shown where to look.